Hello everyone and welcome back to the YouTube channel of BeingACCA. In this video, we are continuing with the PM Pre-December 2024 mock exam. This is going to be the last video wherein we solve the section C last question, Healthy Feet Company of this mock exam. So let's get started. I can see that the first requirement wants me to calculate the standard contribution per pair for each of the three sizes of the work shoe. So, Healthy Feet Company, HF Company, is a family owned shoe manufacturing business that is well known for its handmade work shoes, which they claim to be safer and more comfortable as compared to other work shoes in the market. Given the labor intensive manufacturing environment, it is common to expect some learning curve effects whenever HF is launching a new design of work shoe. HF Company is planning to roll out a newly designed work shoe Comfort with three different sizes in the upcoming quarter. Following information has been extracted from the standard cost card: size medium, small, and large. You have the selling price per pair, direct material cost per pair, variable conversion cost per pair, and the fixed overhead allocated per pair. And there's a star when it comes to the variable conversion cost, as it is likely that an estimated learning curve effect will appear alongside the production. Management accountant has agreed to a standard learning rate of uh, 75%, with the estimated time spent in making the first pair of shoes being at 3 hours. An estimate of the labor hours based on this information has been given below. So the standard labor hours per pair has been agreed as the time spent in producing the fifth pair of shoes. At the end of the quarter, costs and sales information for all three sizes of the work shoes are as follows, and they are adopting marginal costing for output valuation. So the approach that they're using is the marginal costing approach. Now the requirement is asking you to calculate the standard contribution per pair for each of the three sizes. So we are going to start off our workings now. I'll put down my heading, standard contribution per pair of shoes. So I'm going to lay down the sizes here: small, medium, and large. And then I'll have to start off with the standard selling price first. So how much is the standard selling price? It was given here 162, 165. And then for the large one, it is 180. This is the selling price. Now, to find out the contribution, we have to take the selling price, and from that, we need to subtract all of the variable costs, right? That's the formula of contribution. So we move further to the subtraction of the variable costs. Firstly, we are going to subtract the direct material. So as far as the direct material is concerned, it's straight away given. This is 80, this is 85, and this is 90. You can either use a minus sign over here, or you can put it in the formula later. I will put the minus signs here itself. All right, so these are the direct material costs for each of these. Now, when it comes to the conversion cost, the variable conversion cost is the last thing that we need to find out over here. So this depends on the standard labor hours per pair. So for this, we need to run all the numbers with respect to the learning curve to be able to find out how many hours are we taking as the standard labor hours per pair. So this is the table that has been given to us, and we read that standard labor hour per pair will be agreed as the time spent in producing the fifth pair of shoes. So let's go to our workings now. We can do our workings here also. We can fill in this column with probably any of the colors to demarcate that this is from where we are starting with our workings. So I want to find out how much time it has taken for producing the fifth pair of shoes. So how much is the cumulative time that has been taken to produce 5 pair of shoes? If I compare that with the cumulative time of 4 pair of shoes, I will be able to find out how much time it took for the fifth pair. So time, cumulative time for 5 pairs is given to us as 7.7, and then cumulative time for 4 pairs is also given to us as 6.76. Now, if it took me 6.76 hours to make 5 and 7.7 to make, 6.76 to make 4 pairs and 7.7 to make 5, then the difference will tell me how much time it took me to make the fifth pair of shoes. So you can say that time taken for fifth pair will be the difference between these two. So this gives you 0.94. Now this needs to be multiplied with $50 per hour. So if I want to find out the per hour conversion cost, will be simply 0.94 multiplied by the $50 per hour, which I need to absorb. So 47 is what I'm going to charge per hour. Now let's see over here with respect to the variable conversion costs. Now over here, we have found it out for every hour. So we are going to take it as 47. Right, so this is what we subtract from this over here. Now, the next thing that we do is going to give us our final answer, contribution per pair, and it's going to be the sum of all of these. So this is your answer. 35, 33, and 44. You can bold these figures, underline them, because this is the final answer. Another thing to make your answer neat and clean would be to put all of this in a table. Maybe start this table from here. How you create a table is format, go to cells, go to border, pick a color. Color will be black. Then the next thing that we do is select which sort of outline we want. Select all of these and click on OK. So table will be created for you, right? So this is how the presentation can be taken care of. Now with this, we are through with the first part of your last question. Now we will move on to what part B is asking. Coming to part B now, for each size of the shoe, calculate the following variance for the quarter. So we need to find out 3 variants for each sizes of the shoes: sales price variance, sales mix variance, and sales quantity variance. Right, so no advanced variances have been asked over here. These are simple, which you learned in the management accounting exam also. So coming towards it now, this is the answer to your part B, and this is the first part. First part wants you to calculate the sales price variance. Sales price variance, always remember what purpose this variance is for. What does it want to find out? It wants to find out that how much revenue would have you earned if you sold it at the regular prices, sold your quantity that you have sold out in the market at what you had budgeted the selling price to be, versus what is the actual price that you went out and sold it in the market. That's what we want to check here. So we are going to create it for all 3 sizes separately: small, medium, and large. Then the first column, we are going to see how much should have been the standard price, how much was my actual price, and that difference will be then multiplied with the actual quantity. How much have I sold in real? So I'm going to take the selling prices which we had budgeted. These were the selling prices per pair that we had budgeted: 162, 165, and 180. This is what we had budgeted. What are our actual selling prices looking like? Actual sales have been given to us, and we are also given with the actual sales units. So we can find out the actual selling price using this way. that if my total revenue is 18745 and I have sold out 115, then that means 163 was my actual price. Similarly, in this case, my revenue is 12,000 and I have sold uh, 75 pairs, so that makes it 160. Similarly, the actual sales 20130 will be divided by my actual sales of 110. So this gives me my answers. I should have sold it for 162. I sold it at a greater price. That means I have done something good. I have a difference of 1 favorable. Then similarly over here, I should have sold it for 165, but I sold at 160. So that's bad for the business. I sold it at a cheaper price. So that makes it an adverse variance. Then the next thing is I'll apply the same formula here. So this will give me a positive or a favorable variance. Now we just need to multiply this with the actual quantity, 115, 75, 110, and this will give us our variances. So difference multiplied by the quantity. So now if you just sum all of them together, you will get your final answer of 70 favorable. It is very important that you mark over here which is favorable and which is not. So this is your final answer, and you have presented all for the variances for different sizes separately. So this is a good presentation of your answer. Now I move ahead to the second part where I'm required to find out the sales mix variance. So sales mix variance is all about how much quantity I should have sold of each of the, sizes, in what ratio have I followed that or not. And if I have not followed that budgeted ratio, then have I lost out? Have I sold more of the cheaper one, or have I sold more of the expensive one? Obviously, every business will want to sell more of the expensive one. Let's have a look here. How many have we sold in actual sales? Actual quantity, this is the one that we have. So this is what we have sold in real. We can also sum this. So this is what we have achieved in real. Now, if I want to convert this according to the budget, how much should I have sold? So this is my actual sales in budgeted mix. So according to my budget, if my total is 300, how much should I have sold? So I'm going to use the budgeted ratio to find that out. So I can total this. This is 60 plus 100 plus 90. This is going to give you 250. So out of 250 in total, I wanted 60 to be the small size. So this is going to give me 72. Similarly, out of 250, 100, I want it to be the medium size. So I will find it accordingly. And now doing it for the last one, 90 out of 250, I want it to be the large size. So again, the sum should be equal to 300. Otherwise, you have done something incorrectly. So this is how you find out the actual sales according to the budgeted mix. Now you're going to work out the difference. So the difference, you had to sell 72, but you ended up selling more. So your difference will be something favorable over here. So it will be 43 favorable. Similarly, you can drag it to the remainder, right? So now this is a negative one, which indicates that it is adverse. Now moving towards the, what do we multiply it with? So we are going to multiply it with the standard contribution. Standard contribution, we just found out in the previous part, it was 35, 33, and 43. This is what we had found out. And now we will get our sales mix variance. So my sales mix variance will be right here, 106 favorable. For these also, mark it which is favorable and which is unfavorable. Right. So we have now worked out the second part. Also, moving towards the third part where you've got to find out the sales quantity variance. So as far as the quantity variance is concerned, they just want to find out how much you should have sold versus how much did you actually sell. Here you're doing a comparison with the budget itself. So I am copying this much data from here. Right. Now the next thing that I want is how much was my budget originally. So my budget was 60, 100 and 50, and the sum will be, sorry, this is 90, so this gives me 250. Right. Now the next thing that I want to do is find out the difference. I wanted to sell 60, I ended up selling more. This gives me a favorable difference over here. So, sorry, these were my actual sales. It's not copying the values, so I'm manually entering them. All right. So now I should have sold 60 according to my budget, but I ended up selling more. So that is a good thing for me. Hence, it's a positive figure. Similarly, you can drag it down. Overall, also, you can apply this formula and it'll tell you that according to your budget, you were only supposed to sell 250, but you did a good thing by selling extra. And in total, you have sold 50 units extra. Now, again, you're going to take the standard contribution and the sales quantity variance is what you will get if you multiply the difference with the standard contribution. When you sum all of them, so you will get an overall favorable variance. So now you can mark all of them as favorable, and this is your final answer. So with this, we are through with the second part also. Now let's head to the third part of the requirement. Third part of the requirement asks you, there are two parts again to it. Firstly, comment on the possible reasons for each type of variance that has been obtained in these parts. Briefly discuss whether consideration of the learning curve effect is still relevant when standard setting in the next quarter if HF company is planning to replace all the skilled laborers with a computer aided manufacturing technology in the making of shoes. So this is what the requirement is asking you over here. Now let's have a look at it. First, let's address the possible reasons why each of these variances have occurred. Let's quickly go back and see what were the final answers of the variances that we were getting. Firstly, we'll discuss variance wise. Okay, so we'll first discuss the sales price variance. So for the price variance, you see, it is favorable for small size and the large size. Medium size is adverse. Let's have a look here and see what are the possible reasons. We've read the entire information. Okay. All right. So now let's move to the analysis part of it. We are commenting about the reasons. First, we will be talking about the sales price variance. So when it comes to the sales price variance, we saw earlier that these are we have a favorable variance in small size and in the large size, which reflects that we were supposed to sell them at a, because this is a sales price variance. If this is favorable, then that means we sold them at a higher price than we had originally thought. So this can be explained due to the limited availability of the shoe sizes in the market. And even if we were selling at a higher price, we did not have any negative effect on the market competitiveness because you also see that the quantity variance was also favorable. Have a look here. Quantity variance was favorable for all. So that means even if you sold them at higher prices, it did not affect the competitiveness. So what all points are important here? Size small and large, sold at higher prices. So this could be because of the limited availability. Limited availability. Please, you guys need to, properly frame sentences and, write your answer. But for the purpose of this debrief, I'm giving you pointers which are most important, and then you can convert those into sentences to frame your final answer. So, small and large size were sold at higher prices. The possible reason is the limited availability of shoe sizes in the market. And we also discussed that even though there were high prices did not impact sales as quantity variance also favorable is also favorable. Another thing that you can add over here is that the medium size, you have the adverse variance, which means that lower standard pricing policy was applied. This could be explained by the stiff market competition for such a common size. See, medium is the most common size usually that you will observe in any population. So, for this, you are getting an adverse variance because you wanted that you sell it at a decent price, but then due to a lot of competition you had to sell it at the normal price which the customers were accepting. So you can write over here that adverse variance of medium size probably due to stiff competition. Right, this is how you'll explain the first part. Now coming towards the next variance that we calculated, that was the sales mix variance. Let's go back and have a look at the numbers, which was favorable, which was adverse. Sales mix variance, have a look. You had it favorable, adverse, and then favorable again. That means you had to sell more of medium size, but you were able to sell lesser of that. So let's have a look here. The result of this variance is telling you that you have sold higher and more profitable sales. That means shoe size S and L. Have a look here. Which of the sizes give you higher contribution? Highest is given by L, and second highest is given by S. So the products which were giving you higher contribution, those are the ones which have been sold more. So it's a good thing for the business, right? So it is going to make the business more profitable. Let's write about that. Higher contribution is generated by S and L, made us more profitable. Another thing which you can add over here is that what is the explanation? The reason could be that, the sales personnel being asked to promote more aggressively the sizes S and L, given the possibility of limited availability in the market. So you had asked your sales people, sales staff, instructed to aggressively promote S and L sizes due to limited availability in the market. Now coming to the sales quantity variance. Sales quantity variance is favorable for all. That means we ended up selling more than we had discussed. So even though we have discussed all of the possible reasons above, we are getting a favorable sales quantity in all of the shoe sizes. This can be explained by the fact that we were, we were making good quality shoes, and the materials as well as the workers' expertise was a good thing over here. So despite everything, despite all reasons stated above, quantity variance is favorable for all sizes. Reason could be due to good quality, good raw material, as well as craftsmanship, right? So this is your analysis of the variances. Now heading towards the second part of this requirement and the last part of that, where you have to discuss if learning curve effect will be relevant if they are replacing the skilled labors with computer aided manufacturing technology. So we write further about this. See, the learning curve effect usually applies. So if you've studied about this, there were some conditions which were mentioned on the study hub in the content, that when does, the learning curve effect apply. So the conditions in which this applies is that it's a highly repetitive process, it's labor intensive, where the turnover is also less, and there is no interruption which is going to break the learning process, right? These were the conditions which we had studied. So firstly, you will introduce your answer with this. Now you will link it to the scenario. You will say that if HF company is planning to replace all the skilled laborers with a computer aided manufacturing technology, then what is going to happen is all of these conditions which we have laid down, that will be, that will not be there anymore. So if something like this is introduced, the role of direct labor will not be as crucial, will not be as important, and the machine is going to be of more importance. So if you have the absence of labor, it is unlikely that there will be any learning curve effect in this process. So it is more relevant that any new overhead components could arise with the new technology. That means you will now incur more costs over the running of those technologies which you are putting in the process. So with this, we are through with the debrief of your PM pre-December 2024 mock exam. I hope that you found this debrief series helpful, and I wish you all the very best for your final exam. Bye-bye.